Picture a ladder. Every investment that has ever existed, everyone you've heard shouted about online, everyone your uncle swears by, sits somewhere on it. Down at the bottom rung, things are boring, safe, slow, predictable. You always get your money back and you barely feel a thing. Then you start to climb. And with every single rung, the same trade happens, quietly, again and again. You give up a little certainty in exchange for a little more potential. By the time you reach the top, the air is thin, the view is thrilling, and it's the fastest way to lose money you have ever seen. That's the whole game. Not good investments and bad ones, just rungs on a single ladder, each one trading certainty for potential. And the only real question is which rung your money actually belongs on. So that's what we're doing today. We're going to climb the entire ladder, floor to top, and for each rung I'll show you what it really is. In plain English, what job it does, where the catch is hiding, and where an everyday Australian actually buys it. By the end, you'll be able to take any investment anyone ever pitches you and know almost instantly where it sits and whether it's right for you. This isn't a list of hot tips, and it is not one of those American videos full of 401ks and Roth accounts that don't even exist here. This is the Australian ladder, the real one, the one your money is standing on right now. And here's the thing most people never realize. You are already on this ladder. You already own investments today, whether you've ever bought a single share in your life or not. 12% of every pay you earn is being invested for you automatically. Hold on to that because there's one rung here you're already standing on, and it's quietly doing more work than all the others combined. We'll climb to it. Let's start at the bottom. The first rung is cash. Not the notes in your wallet, but money in a high-interest savings account. This is the floor of the whole ladder. You hand it to a bank, the bank pays you a little interest, and you can have every cent back tomorrow morning if you want it. Nothing here is going to fall over. And that's the entire point. This is the rung your emergency fund lives on. The money for anything you'll need soon, and for a lot of Australians, the offset account quietly shaving interest off the mortgage. The catch is so quiet you can miss it for years. If your savings are earning less than prices are rising, your money is slowly going backwards while the number on the screen ticks up. Safe? And going backwards are not the same thing. Cash is where money waits. It's not where money grows. Climb one rung and you reach the term deposit. Same idea as a savings account, with one difference. You lock the money away for a set time, 6 months, a year, 2 years, and in return the bank promises you a fixed rate for the whole stretch. You're swapping access for certainty. You can't touch it early without handing back some of the interest, but you know the exact number you'll have on the day it matures. A drawer you tape shut on purpose for money you already know the date you'll need. Next rung, bonds, the one most people have never really understood. With a savings account, you lend your money to a bank. With a bond, you are the bank. You lend to a government or a big company. They pay you a set rate of interest every year for an agreed number of years, and at the end, they hand your original amount back. Lend to the Australian government and you're about as safe as the money gets. Lend to a company and you're paid a little more, precisely because there's a little more chance they run into trouble. But none of that is really why bonds matter to you. They matter because they're the ballast. They pay a steady, predictable income, and they tend to hold their nerve in the weeks when the share market is falling apart, which is exactly when you want something on your ladder that isn't panicking along with you. Now, before we climb any higher, we need to talk about the rung you're already standing on. The one I told you to hold on to. It's your super. And almost nobody explains this part properly. Super is not actually an investment at all. It's not a rung. It's the ladder itself. Super is a special tax advantage structure the government built, and inside it sit the very same things we're climbing past right now. Shares, bonds, property, cash. It isn't some separate, mysterious asset off on its own. It's a basket of everything else on this ladder. Held inside a structure the tax office treats far more kindly than your own bank account. How much more kindly? Money your investments earn inside super is taxed at just 15%. Outside super, those same earnings are taxed at your normal marginal rate, which for a lot of working Australians is more than double that. Same investments, same returns, a wildly different slice taken out. And this is the part almost nobody uses. Inside that wrapper, you usually get to choose how the money is actually invested: high growth, balanced, conservative, each one just a different mix of the rungs we're climbing today. Most people never move it off the default their fund picked. and never once look. That single quiet choice is shaping your retirement more than any share you will ever pick, on the one rung of the whole ladder where the tax office is genuinely on your side. Okay, back to climbing. Slow down on this next rung because for most Australians, this is the sensible centre of the entire ladder. Exchange-traded funds. An ETF is simply a basket. Instead of trying to pick the one winning company out of thousands, you buy a single thing that holds hundreds or thousands of them at once. Buy one that tracks the Australian market, and in a single trade, you own a sliver of the biggest companies in the country. Buy one that tracks the world, and you own a slice of thousands of businesses across the globe. The job an ETF does is spread your risk so wide that no single company going under can sink you, and the fee is usually tiny, a fraction of a % a year, because there's no expensive manager picking stocks. The catch is that you'll never beat the market, because you are the market. But here is the quiet truth most professionals won't say out loud. Over the long run, simply owning everything cheaply, drip-feeding a little in every payday, and leaving it alone for years beats almost everyone who tries to be clever. And one rung up sits exactly that. A single share, bought on its own. A share is a genuine slice of ownership in a real business, so when it grows, you grow with it. Many established Australian companies also hand a slice of their profits back to shareholders a couple of times a year, called dividends, and here those often come with franking credits attached, which means the company has already paid tax on that money, so you're not taxed on it twice. I have a video that goes deeper into how franking credits work, which I've linked in the description. That's the upside, and it's real. So is the fall. A basket can absorb one company collapsing. A single share cannot. One company can soar and genuinely make you, and one company can miss its numbers, drop 40% in a single morning, and take your money with it. This is the rung where being right pays off handsomely. Being wrong actually stings, and it asks far more homework of you than a basket ever does. Keep climbing and the ground changes from paper to bricks. Property. Buying a place, usually with a big chunk of it borrowed from the bank, and earning rent while you hope the value climbs over the years. It's the most emotional rung on the whole ladder, because you can stand inside it, and because it's minted more Australian fortunes than almost anything else. But it asks the most of you by a distance. An enormous deposit just to begin, then stamp duty, decades of mortgage, rates, insurance, and the leaking taps. The double-edged feature here is leverage, because you control a whole property with only a fraction of its price as your own. A small rise in value is a big gain on your deposit, and a small fall can wipe it out just as fast. And it's the least liquid rung there is. When you suddenly need a bit of cash, you can't sell the laundry. You have to sell the whole house, which is exactly why the next rung exists. A listed property trust or Australian Real Estate Investment Trust. An A-REIT for short. Think of it as property without the mortgage, the tenants, or the 3 a.m. phone calls. You buy units, just like shares, in a trust that owns the big, serious stuff. Shopping centres, warehouses, office towers. The rent flows back to you as regular distributions, and by law, these trusts must pay most of their income straight out. So you get the income of commercial property without the deposit or the loan, and you can sell your slice on any ordinary trading day. The trade-off is that the price wobbles daily, the way shares do, while your own home just sits quietly in the background. Now the rungs start getting genuinely thin. Commodities. Gold, silver, oil, wheat, copper. Real, physical things. The defining difference from everything below is that a commodity pays you absolutely nothing while you hold it. No rent, no interest, no dividend. A bar of gold just sits in a vault being a bar of gold. The only way to make money is for someone to later pay you more than you paid. People reach for gold mostly as a kind of insurance, something that often holds its value when shares and currencies are falling apart. But never lose sight of what it is. Insurance against fear, not an engine of growth. Higher still, and the air gets thinner again. Crypto, Bitcoin, Ethereum, and the thousands of coins that have chased them. A digital asset with no building behind it, no company, no rent, no profit underneath holding the price up. What it's worth tomorrow is driven almost entirely by what the next person will pay. And the market never closes. It runs all day, every day, around the world. That is exactly why it can double in a month, and exactly why it can halve in a single weekend. A few people have done extraordinarily well here, and far more, much more quietly, have not. If it has a place on your ladder at all, it's a small one, right near the top, with money you have genuinely made peace with losing. And right at the very top, on the thinnest, windiest rung of all, sit options and other derivatives. These aren't really investments, they're contracts, bets on which way a price will move, and by when, often with borrowed money stacked on top to magnify everything. Used carefully, professionals treat them as tools, a way to hedge a big holding against a fall. Used hopefully by someone chasing a fast fortune, they're closer to a casino with a maths degree. They can multiply your money startlingly fast, and they can lose you more than you ever put in. For all but a tiny experienced few, this is the thin air where most people who climb up simply fall off. There's also a small platform bolted off to the side of the ladder, not really part of the climb. Collectibles, art, watches, wine, classic cars, trading cards. They can rise beautifully, but they pay you nothing while you own them. They cost money to store and insure. They can be painfully slow to sell when you actually want the cash. And it takes real expertise not to badly overpay. Wonderful as passions, shaky as a plan. So there's the whole ladder, from the safe, slow floor of cash and term deposits, up through bonds, your hardworking super, the funds and shares where most real wealth is built, then property, and finally the thin, dangerous air of commodities, crypto, and options at the very top. Here is the part that turns all of this from a list into something you can actually use. You were never meant to pick one rung and call it the best. The right rung isn't decided by the investment at all. It's decided by your timeline, by one question. When do I need this money back? Money you need within the next year or two, an emergency fund, a house deposit you're closing in on, belongs on the bottom rungs. Cash and term deposits. Not because they're better, but because the higher rungs can drop 20% the month before you need it. And certainty is the entire point. Money you won't touch for 10 years or more belongs up in the middle. The funds, the shares, your super. You're being paid for time, and time is what smooths the bumps out. And money right at the very top, the crypto and the rest, should only ever be money you could watch vanish and still sleep soundly that night. There's no good investment and no bad one. There's only the right rung for the time you've got. If this finally made the confusing world of investing sit still and make sense, share it with someone who's been meaning to start and has no idea where the first rung even is. One last thing before you go. If a lot of this felt brand new, if investing has always sounded like a language everyone else somehow learned without you, please don't carry that as a weight. None of it is taught to us properly. Starting at the bottom of the ladder isn't being behind. It's just standing exactly where everyone sensible started. So here is where I'd point you next. Everything we climbed today is really just one rung of a much bigger picture. I've made one long video that walks through that whole picture, for Australians, from the ground up, in the order it actually matters. Your pay and tax first, so you finally know your real numbers. Then super, the rung you're already standing on. Then debt, investing, property, and the life stage decisions that quietly move every other number. And finally, how to pull all of it together into one system that just runs. It's a long watch, I won't pretend otherwise. But it's the single best place to start because everything else here is built on top of it. The video's right there, and I'll see you over on it.